And I'm joined now with Jason Schenker. He is, of course, the chief executive with Prestige Economics from Texas. Great to see you, Jason. Thanks so much for joining us.
Great to see you too, Edna.
Now, we were just listening to Ben Bernanke last night, and he was saying that, the economy in America is frustratingly slow recovery. But then he added, accommodative policy is needed for this uneven recovery. What exactly do you think he means?
Well, the truth is that right now the U.S. economy is in recovery, but it's a slow recovery, and it's a lot slower than what people view as U.S. potential growth. What this means to the oil markets is that there could be further dollar weakness. If the Fed keeps rates exceptionally low, if they were to consider another round of quantitative easing, which has a very low probability, but seems to be even though the probability is very, very low, the probability is a little bit higher today than it was yesterday that they can engage in more quantitative easing. It's their only other accommodative policies they have left if the U.S. economy were to stall. But regardless, the Fed is going to be raising rates a lot slower than other central banks. The U.S. economy is not in as good a shape, and there are major debt concerns around the U.S. All that is wildly bearish for the dollar, huge downside risk for the dollar, huge upside risk for crude oil.
Now, we've seen the dollar actually on a steady decline, and no sign of that easing right now. What's the outcome? What's the danger that's lurking there if this continues, and how long can it go on?
Well, for decades, the dollar has been in a secular decline. I think the decline is likely to continue. The major risks are that what happens if it begins to decline in a more rapid fashion? What happens if something else Ben Bernanke mentioned yesterday was the need to address long-term fiscal consolidation, address the debt issues that are lurking not only in the United States at the federal level in terms of our spending, but also in terms of U.S. entitlements, off-balance sheet, basically pension liabilities, Medicare, Medicaid, Social Security. These sorts of things have not been paid for. They're a major risk, and there's a major need to address them. The problem is what happens if we get a credit downgrade because we don't address these issues. That's going to really cause a significant drop in the dollar. What happens if this sort of steady decline in the dollar becomes a free fall?
But, I mean, America's got itself into this situation. It didn't happen just yesterday. I mean, they put a bit of work into getting on that one. But they're also putting pressure on the likes of OPEC and also saying that, the high price of oil is impacting their sad economy right now.
Well, that is definitely something. Ben Bernanke had also said that basically high commodity prices, which are contributing to inflation, are a result of the fact that supply isn't meeting demand in the marketplace. Well, we all know that supply is meeting demand, and supply does exceed demand. In the medium and longer term, are there concerns about global oil supply meeting rising global demand? Well, yes, but the result is going to be that those prices rise, and then what you have is a change in the marginal consumers. For the U.S., this means that you're going to see additional inflationary pressures because we're still going to buy gasoline. Even though the price of gasoline in the U.S. is up a third higher than it was last year, demand's down about 2%. So the U.S. consumers are wildly inelastic to the higher prices. Supply does meet demand. It's just prices are rising because the dollar's falling, and increased global demand for oil is rising as well.
But the stockpiles are looking pretty healthy still in America. What have you got, 55-day advance cover or something? But that's reasonably good.
Yeah, there are reasonable inventories everywhere. There is no shortage of oil. Despite what's been going on in Libya with the supply disruption from their production, it doesn't matter. The global oil supplies are still meeting demand. There are no reports of shortages, but the result is simply that the price of oil is going up. And that's likely to continue. We're likely to see higher demand growth in the back half of this year and into next year, because even if the U.S. economy recovers at an uneven pace and is a little sluggish at 2 to 2.5% instead of 3 to 3.5%, the U.S. economy is still growing and the global economy is still growing.
Now, what about Europe? What about OECD? A bit of a bright spark coming out of Germany. Is that the only savior in this region at the moment?
Well, no, a lot of European economies look very good. There are sovereign debt concerns for a number of the PIGs, as they're called, especially with Greece right now, sovereign debt concerns. But the sovereign debt concerns and the GDP of Greece are very small compared to the debt obligations of the United States. To put it in perspective, Greek GDP, which is 300 billion plus, is relatively small. The U.S. economy is going to grow by about $300 billion this year, even if we see 2 to 2.5% 2.5% U.S. GDP. A whole nother Greece is going to be created in the United States because of U.S. growth. So Greece is very small, and in terms of the U.S. debt, even if Greek debt to GDP ratios were to be double what they are, say they were to rise even higher in an exponential fashion and end up being a $600 billion obligation, the U.S. debt obligation is many fold that. And if you look at federal debt, $14 trillion, you look at state muni obligations, another $7 trillion, and that doesn't include the off-balance sheet obligations. Trillions and trillions and trillions versus what you're seeing in some of these other sovereign debts where we have concerns. What it really means is that we might be mispricing U.S. sovereign debt. Again, further downside risk to the dollar. And in Europe, things look pretty good except for a few pockets.
The economy is down. We have Libya situation. We've got a lot impacting oil right now.
Well, I would say I don't feel like the economy is really down. Again, to point out U.S. GDP, Ben Bernanke and many analysts who would boo-hoo about GDP growth in the U.S., it's 2 to 2.5%. Again, on a 13 to $14 trillion economy, this is a lot of growth. And people need to realize that this is going to be somewhere between probably the 20th and 30th largest economy in the world that's going to be created as a result of this growth that's on top of what's already in the U.S. People forget that. The growth is still strong. Globally, you're looking at global GDP growth probably between 4 and 4.5% this year. You're looking at strong growth. You're looking at isolated pockets of weakness, but China, India, Brazil, a number of other emerging market economies are going to contribute to additional marginal demand for crude oil, and you're seeing so much higher growth rates in those countries. This is really going to be, the demand is going to remain high, and we're going to see the highest growth we've ever seen in the United States this year. It's going to be higher than the levels we saw in 2008, and we're going to see the highest level of global growth we've ever seen this year, and it's only going to go up. 2011 is sort of like 2008. And we saw that big run-up in commodity prices, and then they came down. But there are two differences. One, they didn't come down as far, and some of it was because the dollar got stronger and got a little bit of a bounce. The second thing is that it's also 2011, it's a little like 2004 because we're at the beginning of a business cycle. And even if the U.S. growth isn't as big as we otherwise would expect it to be at 3.5%, it's only at 2 and 2.5%, we would still say that the global economy is still really strong, and you're looking at more growth going up into the future.